Hashtag how to analyze a real estate investment deal. Most people who lose money in real estate don't lose it because the market crashed. They lose it because they never learned how to properly analyze a deal before buying. They saw a property, felt excited, ran the numbers loosely in their head, and convinced themselves it would work out. It didn't. Today, we're going to make sure that never happens to you. This is a complete, step-by-step breakdown of how to analyze a real estate investment deal, the exact same framework used by professional investors managing millions of dollars in property portfolios. Whether you're buying your first rental or your 50th, this process applies every single time. Hashtag understanding why deal analysis matters. Before we get into the numbers, let's establish something important. Real estate investing is not gambling. At least, it shouldn't be. The difference between a seasoned investor and a first-time buyer who gets burned comes down to one thing: process. A disciplined investor never falls in love with a property before the numbers do. Emotions are the enemy of good deal analysis. A beautiful house in a desirable neighborhood can still be a terrible investment if the price is wrong, the expenses are too high, or the rent potential doesn't support the debt. Every single year, billions of dollars in wealth are created through real estate. But for every investor building generational wealth, there's another who bought a bad deal and spent years recovering from it. The framework we're walking through today eliminates most of the guesswork and gives you a reliable, repeatable system to evaluate any deal you encounter. Hashtag step 1, define your investment strategy. The very first step in deal analysis happens before you even look at a property. You need to define what you're actually investing for. Are you looking for monthly cash flow, money coming in every single month above your expenses? Are you focused on appreciation, buying in growing markets where the property value climbs over time? Are you considering a short-term rental strategy on platforms like Airbnb? Or perhaps a fix and flip where you renovate and sell for profit? Each strategy changes how you evaluate a deal entirely. A long-term buy-and-hold rental in a stable Midwest market like Indianapolis or Columbus operates on different metrics than a short-term vacation rental in Scottsdale or the Florida Keys. Knowing your strategy first means you'll know which numbers matter most before you pull a single data point. Hashtag step 2, gather the property's financials. Once you know your strategy, you need to collect 3 categories of financial data about the property: income, expenses, and financing costs. On the income side, you need to determine realistic gross rental income. This means researching what similar properties in the same zip code are actually renting for right now. Not what the seller tells you. Not what was rented 3 years ago. Current, comparable market rents. Websites like Rentometer, Zillow Rental Manager, and local property management companies can give you solid comps. For example, if you're analyzing a 3-bedroom, 2-bath single-family home in Memphis, Tennessee, and comparable homes are renting between $1,100 and $1,200 per month, you use $1,100 as your conservative estimate. On the expense side, this is where most beginner investors make their biggest mistakes. They undercount expenses dramatically. A thorough expense analysis includes property taxes, insurance, property management fees if you're not self-managing, typically 8 to 10% of collected rent, maintenance and repairs, vacancy allowance, capital expenditure reserves, utilities if you're covering any, and HOA fees if applicable. The vacancy allowance is critical. No property is rented 365 days a year indefinitely. A conservative industry standard is 5 to 8% vacancy annually. On that $1,100 per month property, that's roughly $55 to $88 per month you need to budget as if it were lost income. Capital expenditures, often called CapEx, are the big-ticket items that will eventually need replacement. Roof, HVAC system, water heater, appliances, flooring. Experienced investors typically reserve 5 to 10% of gross rent per month specifically for future capital expenditures. Ignoring this line item is how investors get blindsided by a $12,000 roof replacement 5 years into ownership. Hashtag step 3, calculate net operating income. Once you have your income and expense numbers, you calculate what's called net operating income, or NOI. This is your gross rental income minus all operating expenses, but before your mortgage payment. NOI is one of the most universally used metrics in commercial and residential real estate investment. Using our Memphis example, gross monthly rent of $1,100 multiplied by 12 equals $13,200 annually. Subtract annual operating expenses, property taxes at $1,800, insurance at $900, property management at $1,320, maintenance and vacancy reserves at $1,500, and CapEx reserve at $1,320. Your total annual operating expenses come to approximately $7,140. Subtract that from $13,200, and your NOI is approximately $6,060 per year. Hashtag step 4. Evaluate the cap rate. Now that you have your NOI, you can calculate one of the most important metrics in investment real estate, the capitalization rate, or cap rate. The formula is simple. Divide your NOI by the property's purchase price, and multiply by 100 to get a percentage. If that Memphis home costs $110,000 and produces $6,060 in NOI, the cap rate equals approximately 5.5%. What does that mean? It means if you purchased the property entirely with cash, you'd earn a 5.5% annual return on your investment before financing costs. In most Midwest and Southern markets, a cap rate between 5 and 8% is considered acceptable for residential rentals. Coastal markets like Los Angeles or New York often see cap rates between 3 and 5%, reflecting higher appreciation potential but lower immediate income returns. Cap rate also helps you compare deals quickly. If you're evaluating 5 different properties, calculating cap rate on each gives you an apples-to-apples comparison regardless of price differences. Hashtag step 5. Calculate cash-on-cash return. Cap rate tells you how a property performs without a mortgage. Cash-on-cash return tells you how it performs with one, which is far more relevant to most investors who are using financing. The formula is annual pre-tax cash flow divided by total cash invested, expressed as a percentage. To determine annual pre-tax cash flow, take your NOI and subtract your annual mortgage payments. Using that same Memphis property at $110,000 with a 20% down payment of $22,000 at a 7% interest rate on a 30-year mortgage, your monthly principal and interest payment is approximately $586, or $7,032 annually. Subtracting that from your NOI of $6,060 leaves you with a negative $972 in annual cash flow. That deal does not cash flow at those numbers. This is exactly why running the full analysis matters. A property that looks promising on the surface can fail the cash-on-cash test quickly. In this scenario, an investor would need to either negotiate a lower purchase price, find a market with higher rents, reduce financing costs, or move on to the next deal. Professional investors are not emotionally attached to a specific property. They're attached to their return requirements. A healthy cash-on-cash return target for most buy and hold investors sits between 6 and 12% annually. Anything below 6% in today's interest rate environment often means the deal requires too much capital at risk for too little monthly reward. Hashtag step 6. Run the 1% rule as a quick filter before you invest hours into deep analysis. Experienced investors often use the 1% rule as a fast screening tool. The rule states that a property's monthly rent should equal at least 1% of its total purchase price to have a reasonable chance of cash flowing. A $100,000 property should rent for at least $1,000 per month. A $200,000 property needs at least $2,000 per month. This is not a definitive investment decision, it's a filter.